The US dollar is finally starting to trade in line with fundamentals, and that may have important implications not only for precious metals, but also some of the long duration momentum trades that have ripped high in the AI speculative frenzy seen in recent months. If we start with the dollar index chart, we've now seen a bullish breakout from the downtrend that had been in place since March, with the DXY smashing through the 50, 100, and 200-day moving averages in quick succession. The next major level sits at 99.31. If the big dollar breaks that level, it suggests that direction of risk may no longer be sideways, but potentially shifting higher. What's important here is that the move finally aligns price action with the macro fundamentals that have been screaming for weeks that the dollar should be trading higher. US growth has remained resilient. Inflationary pressures have broadened again, and Treasury yields have continued to push higher, yet the greenback kept softening until recently. That divergence now looks to be correcting. If we move to the US inflation charts, the pane on the left is CPI while the right shows upstream producer prices, with the headline inflation in blue and core in red. You can see CPI remains well above acceptable levels. What really stands out though is the renewed acceleration in producer prices. Pipeline inflationary pressures are clearly rebuilding. And that's not just isolated to the US either. Over the past 24 hours, we've also seen import price data out of Japan, reinforcing the idea that global cost pressures are broadening and deepening. Markets are now being forced to respond to that inflation pulse, including in the United States. Fed pricing has shifted materially, with futures markets now implying around 12.5 basis points of hikes by the end of this year. A massive repricing from early March, where markets were still pricing more than 2 full cuts. That brings us to what is quickly becoming carnage in long bonds around the world. The combination of intensifying inflationary pressures, front-end yields remaining pinned, and simmering fiscal and economic concerns further out the curve has seen long bonds belted. You can see it clearly across the US, the UK, Europe, Australia, and especially Japan, where 30-year yields have surged higher. Now, Japan matters more than most because of its importance to global capital flows and funding markets. So this is not something markets can easily dismiss as a local story. It has global implications. The combination of rising risk-free rates and a rapidly strengthening US dollar creates a very tough environment for non-yielding assets like gold and silver. But the risks on this occasion extend well beyond metals. Many of the long-duration momentum trades that have exploded higher during the AI build-out story have benefited enormously from multiple expansion and optimistic assumptions around their future growth prospects. While earnings momentum has helped underpin the rally, the real economy still needs to remain strong enough to justify the scale of spending. If growth were to slow or financing additions tighten materially, that enthusiasm may cool very quickly. And with valuations already stretched, the adjustment could become violent. What markets may be finally starting to acknowledge is that the inflation and yield backdrop that has been building for months is now far too significant to ignore.